Before we really proceed, I just want to talk about a few quick things so that we would know. So I hope you're comfortable with call. You can see my screen, right?
Absolutely, yeah.
And along with that, you're comfortable with ITM, OTM,
Yeah,
ATM.
yeah.
Then you still remember what a covered call is and what a protective put is. What is a covered call? Quickly.
You short a call and you own the stock.
Longer stock
Yeah,
and
longer
then you
stock.
sell a call, right?
Yeah.
Okay. How about protective put?
Your longer put and longer stock.
And how about collar?
Caller is you buy a put and a call of the same strike price. Hello?
Yeah, yeah. I'm saying no.
Oh, caller, caller. Just a sec. Yeah. So caller is the sorry, it's the bounded return, right? I
Hmm.
think that was the straddle.
What you said before was a straddle, yes.
Yeah.
And what was
Uh,
collar? How would you create a
caller
collar?
caller is basically you you buy a call and then you sell the call. Like you buy a call of a lower strike price and then you sell. So that can also be one of the bull spreads that we did. But the other way to do
Again,
all
no. In
okay.
spread, you don't long a stock.
Yeah.
In
But
spread,
you long a call and then you short a call of the higher price, right? That's the
correct.
spread.
Yes, that is true.
So
So that's
caller
the
means
reason.
if you own the stock,
Mhm.
you you then short a call, right? So that caps your upside, and on your downside, it's a protective put. I mean, it's a long call, a long put.
Exactly. So when you say that you long a stock and then you sell a call,
Hmm.
is it not as good as a covered call,
Covered, yeah, covered call plus long put,
right?
protective
And
put.
then you are long a stock and then you're long a put, then aren't you a protective put?
Yeah.
So I observed this even yesterday that you were unsure about collar,
Hmm. Hmm.
ठीक है?
Hmm. Hmm.
And आज
Hmm.
भी वही same था. So that's the reason
Hmm.
I wanted you to reiterate so that you have
Hmm.
अभी वो
Hmm.
दो तीन बार layer लगेगी ना दिमाग के ऊपर तो वो settle कर जाएगा.
Yeah.
ठीक है? So I'm saying always remember we started out with covered call, protective put, and then the collar is a sum of the below above two.
Okay. Okay. Yeah.
So if you can remember that, you can create the
Yeah.
strategy.
No, that's
Collar
helpful.
is the sum of covered call plus protective put, right? All right. I think you are very much comfortable with the next strategy, which is straddle,
Yeah.
right? So you are long a call plus long a put at the same strike price.
Yeah.
Next thing that we talked about with the spreads, and then we said, what is a bull spread? When I say bull spread, it means bull call
Long.
spread,
Yeah. Bull call
long a
spread.
call, and then
You short a call of a higher strike price.
perfect, right? What's a bear spread?
You you long a put of a higher strike price, and then you short a put of a lower strike price.
Then we talked about the Greeks, right? I don't have to
Yeah.
mention anything. Quite
Yeah.
perfect.
So theta
Acha.
is theta
So
is
something that I want to just highlight as a
delta. Sorry.
refresher
Yeah.
is the delta is for call it goes
Positive.
from 0 to 1,
0 to 1.
put 0 to -1,
Yeah.
right? In absolute terms, 0 to 1.
Yeah.
Theta always negative.
Yeah.
Vega, always positive.
Yeah.
Gamma, maximum at ATM.
Mm.
Okay?
Yeah.
All right. Also, for a long position, the delta is +1.
Yeah.
And for a short position, the delta is -1. So far, so good.
Yeah.
So by that way, we know कि क्या-क्या हमारे basic and last thing before we start is when it comes to Vega, and let's say they give you a annualized volatility.
Yeah.
So anything that you would change in terms of months or years, you would do a under root of something.
Yeah.
Perfect. There are two more things in this topic majorly.
Mm-hmm.
One is volatility smile versus volatility skew, right? Let's just try to understand when it says it's a volatility. So we're talking about obviously the risk, the volatility that we know already.
Yeah.
The important contrasting word over here is smile versus skew.
Okay.
So the topic goes by this that when it comes to volatility, it is lowest, the volatility is lowest at ATM
Mm.
while it is highest at either OTM or ATM, which
Oh,
means that if on a curve of this, your volatility smiles looks like something like this,
okay.
where this is the ATM and this is, let's say, if this is an OTM, right? This is a strike price. This is the implied volatility,
Mm.
and this could be a OTM for put or maybe ITM for a call and vice versa.
Mm.
So your book says about this, but the question is, and this is a question from my side, on why do you think that it is lowest at the ATM only? And you can imagine, right, why the name Smile? Because of the shape.
Yeah.
But a simple question is that why do you think that it would be the lowest at ATM? Okay, you won't be able to guess it, I'll tell you.
Mm.
So the point, and your book doesn't talk about this, but let me
Okay.
tell you that what do you mean by implied volatility? The implied volatility says that how do people perceive the change in price.
Mm.
That's how the volatility becomes. When the prices are at the ATM,
Yeah.
anything that you're going to calculate is already reflected in the market right now. So
Yeah.
when your stock price is very close to the strike price,
Mm-hmm.
it is as good as the present time.
Yes. Yes.
Obviously, right? When the strike price is equal to the stock price, it means you are at present. At present, you know everything. You know the risk. You know what's going on. You know that this is the price. I can buy at this price. I can sell at this price. So when you
Yeah.
know things, the uncertainty is less.
Mm.
Basically, this is about the present, right?
Yes.
At present, the uncertainty is less. You know if I have passed or if I have failed,
Yeah.
right? So when the uncertainty is less, it means the volatility is less.
Mm.
However, when the option is out of the money or in the money, people only speculate
Mm. Mm.
that the price will go up and it will become ITM. The price
Yeah.
will go down and become ITM, or maybe it is currently OTM and will become ATM or ITM.
Yeah.
They speculate. So in that case, it is more, right? That's the reason you have the volatility, the implied volatility is lowest at ATM,
Hmm.
because the uncertainty is less. It means you don't have to speculate anything. You can always calculate the implied volatility, and it will be equal to the current risk factors in the market. You don't have to put any extra parameter for uncertainty.
Okay.
Make sense?
Makes sense.
So this is called as volatility smile, the name smile. But then this is less common.
Hmm.
And the reason why this is less common is because we assumed in this case that how people perceive OTM versus ITM, and how do people perceive a call OTM and ITM versus a put OTM and ITM are same. There's an
Okay.
assumption here. You see that?
Yeah. Yeah. Correct.
Because it's symmetrical.
Right.
But that's not the case in usual markets. So this is
Hmm.
kind of a volatility smile as a topic, but in real world, you don't see much of a volatility smile. Rather,
Hmm.
you see volatility skew.
Hmm. Hmm.
Now, what is a volatility skew? First, the name clearly explains skew. Skew means when they say that the data is skewed, it means it has been drifted towards somewhere.
Okay.
The data is not symmetrical. It is the data is skewed, right? If you are working in financial domain and if you work with data, right,
Hmm.
you would see outliers in the
Hmm.
data.
Hmm. Hmm.
So those outliers skew the whole data. It means it
Hmm.
just जैसे अभी सोचो averages, let's say 5, but in the whole series you have one data point which is 1000. It's an outlier, but it takes up the whole average to a new average of 200. On a series of single digit numbers, if you have
Yeah.
an outlier, it just increases the whole average, right? So I would say that the data is skewed. So what we do is we just eliminate the outliers and then renormalize the data,
Hmm.
right? So in that same way, it says the volatility is skewed, which means that it's not symmetric, and why this is skewed and to which angle it is skewed, it all depends on the demand and supply. And moreover, more than that, it is the perception of people. Now, what does this perception of people?
Hmm.
If they think, if they think that the market has gone up a lot and the market is going to be bearish now,
Hmm. Hmm.
to be
Hmm.
bearish, then the whole thing is skewed towards the OTM put is more valuable.
Hmm. Hmm.
Does it make sense?
Yeah.
So if the people would perceive that the market is going to be bearish, as we talk about implied volatility, which means what is going to happen in future, a lot of people, a lot of people is going to put their money in OTM put. And you
Hmm.
know why? Because buy an OTM put right now and they will become a ATM or a ITM in some time,
Yeah.
right? For a stock price of 100, will my OTM put be 30 or 200?
Um. The value of the put, like.
Yeah, it's not about the price, but the strike price. So for a strike price of 30 versus a strike price of 200, which one would be called as OTM put?
The 30.
The 30, right?
Yeah.
For a current market price of this, it is 30 as OTM put.
Yeah.
So this will weigh more if the people would perceive that the market is going to be bearish,
Hmm.
right? So the point I'm trying to make over here is, and
So
I'm
in this in
contrasting
this
this.
in this curve, What is on the x-axis?
Yeah, it's the same. The implied volatility.
No, x-axis.
Oh, it's the strike price.
Got it. Got it.
The strike price. So the point I'm trying to contrast is a smile versus a skewed data is
Uh-huh.
that in the real world, when people would, and obviously, right, people will have at least some view. They will not
Correct.
never have a neutral view. Either they will say the market is bearish or they will say the market is bullish. In either of the scenarios, either they will put more weight on the OTM put or they will put more weight on the OTM call. In either
Yeah.
of the cases, the graph is skewed and not symmetric,
Yeah.
right? And hence the name volatility skew. Make sense?
Makes sense.
Okay. Perfect. Let's just try one question and see if you understand that. There's one more word that they mentioned somewhere, delta hedge.
Okay.
But I think we understand this word now, right?
Yeah, yesterday we did it, right? Like,
Yeah. So you can also see, right, because they explained something, but then what they're trying to say is that we did a short position will experience equal and opposite gains to the risk reversal.
hmm.
Basically, they were long something,
Yeah.
and then they look at the overall position and they took a equivalent short position in such a way that there is a opposite gain and losses which will reverse the risk, and hence the delta is hedged completely, and
Hmm.
no matter where the price would move, right, it is going to stay with us as in the risk would be eliminated. Make sense?
Right. Makes sense.
Let's just try these two questions and see if it makes sense.
An investor has a long-term bearish view on Acme stock price, but over the next 2 months, he anticipates very little price movement. An appropriate strategy to benefit from this view would be to buy ATM calls on Acme with 2 months to expiry and sell ATM calls on Acme with 5 months to expiry. Sell ATM puts on Acme with 2 months to expiry and buy ATM puts on Acme with 5 months to expiry. Buy OTM calls on Acme with 2 months to expiry and sell OTM puts on Acme with basically this is a short calendar spread. So it'll be B.
You know what? When I read this question, I just read there is a long-term bearish view, which
Yeah.
struck me out, and then it said there is a very little movement.
Yeah.
So when I read the word very little movement, I just thought that there would be something that I can gain in a short term, right?
Yeah.
When the
Yeah.
price movement is very little, so if I can sell something for a short term,
Yeah.
I can gain something, right?
Yeah.
And what is short term?
Yeah.
There is no way that I could be for a short term. I could
No,
be
no.
buying something for 2 months.
That'll be expensive. Yeah.
Makes no sense, right? Even if I
Yeah.
buy these two things and the price movement is very less, they will go optionless. They will go
Yeah.
expire. How about the second one?
Following statement is most correct. A long straddle is a strategy based on the implied volatility smile. Since the further the underlying moves from the strike by the expiration of the options, the greater the profit from the strategy. Volatility skew describes the empirical situation where implied volatility increases for more OTM calls and decreases for more OTM puts. Volatility skew describes the empirical situation where implied volatility increases for more OTM puts and decreases. So A.
So look at this. A long straddle is a strategy based on the implied volatility smile. Since the further the underlying moves from the strike price by the expiration of the options, the greater the profit from the strategy.
Right.
Is it based on the implied volatility smile?
No. No. Yeah.
One thing.
Yeah.
And second, when we talked about long straddle, did we even talk about volatility at then?
No.
So let me tell you, I think this is important information to tell you that for all the strategies that we have studied,
Yeah.
all the strategies, whether it is collar, whether it is covered call, covered protective put, straddle, bear spread, bull spread, all of these strategies assumed a constant volatility.
Ah, okay, okay, okay.
They assume constant volatility. Otherwise, when we say that the call option price is 3 rupees and at expiration the strike price is this much or that much, we will
Yeah.
not be able to say anything for sure unless we keep a few data points constant.
Mm-hmm.
Right? So long straddle has nothing to do with implied volatility smile.
Mm-hmm.
Right? I know where you're coming from, where you thought that okay, this is like a curve, which means
Mm-hmm.
both side upward sloping, so looks like a straddle, and you chose A. Right? So it could be a immediate response to what you studied, which is fine, right? I wouldn't say, but I'm just letting you know that for all the studies that we have studied, the volatility is kept as constant. And if we apply those volatilities in those things, then none of the things that
That,
we have studied seem right.
right.
Right? Because
No,
everything, the
so
strike price.
yeah, no, on option B and C, it really
Yeah.
depends on the view of the market, right?
Okay. Let's just try to understand PNC.
Volatility skew describes the empirical situation where implied volatility increases for more OTM calls and decreases for more OTM puts. Okay, that basically there is a skew then. That I agree. No, OTM OTM calls and OTM puts. Okay, yeah. So volatility skew describes the empirical situation where implied volatility increases for more OTM puts and decreases for more OTM calls. Yeah,
Okay.
I feel like it
This,
just has to depend on the market, right? Like
okay.
what the view is.
Okay. I agree with you even on this point, right? Now let's just talk about a little more holistically.
Hmm.
Where is the more risk, when the price goes down or when the price goes up?
When the price goes up, your whoever is short that thing will lose out the most. Like it's
Okay.
unlimited loss for the
Okay.
guy.
In terms of call and put, I agree. I'm saying that when do you feel more, okay, you have a stock.
Hmm.
You have a stock. When do you feel restless? When the price is going up or when the price is going down?
When it's going down.
And whatever happens to you, do you think that same thing would happen with everybody in the world?
Yep. Correct.
Right? So do people scared more about the falling in the prices or rising in the prices?
Falling. All right.
Falling, right? So don't you think whatever you're saying is right if we have more information?
No, it makes
But
sense. Yeah.
given what's over here in B and C,
Yeah.
although you can say that it all depends on the perception, but you have to choose one option, right? So which could be
Correct.
the
Correct.
best option? So you will
Hmm.
feel that when the market is going to be bearish, it is more riskier.
Yes.
If the market is going to be bullish, that's fine, right?
Yeah.
Although think about this. Matlab, we talk about this in general things, that do you like, and then sometimes I just do kind of a pro bono things with people
Hmm.
when they say that they want to invest some money.
Hmm.
And I said, how much risk are you willing to take?
Hmm.
And they tell me, Ankur, I'm okay to take risk.
Hmm.
I said, how about your 100 will become 200? And they
Hmm.
said, nothing
Hmm.
like.
And
So
then the
that's a risk,
100
right?
becoming
Volatility.
50.
But then 100 becoming 10,
Zero.
would
Yeah.
you like that? He said, no, I don't want that kind of a risk. So come on, matlab, the risk is same, right? You go
The
up or
risk
you
is
go
same.
down, the risk
Yeah.
is risk,
Yeah.
right? But then this will panic people while they are
Hmm.
very much comfortable with this kind of risk, although the risk
Yeah.
is same. So
Like
I'm
loss
saying
reversal. Yeah.
exactly. So you can't say that the risk appetite for a loss is not equal to risk appetite for a profit. Although
Hmm.
the in terms of theoretical terms, the risk is risk. So I'm saying in terms of volatility,
Yes.
right? People put more weight in OTM puts because
Hmm.
that represents a bearish market. Does it make sense?
Yep.
So it is more skewed towards OTM puts, everything else same,
Yeah.
assuming that people would want to hedge their position in case they're long. because they are skeptical about the decrease in the price. If it increases, still okay, the premium could be lower. But now look at this. The volatility skew describes an empirical situation where the implied volatility increases for more OTM puts and decreases for more OTM calls.
Yeah. Yeah. See. Yeah.
Right? Okay. So if they give you more information, that's fine. But if they don't, you have to choose something that relates to the bearish market.
Yeah.
Let's do this. Again, we will just go through them and understand if we are okay with them or not, and maybe solve if required.
So which one exactly? The covered call
First one.
scenario?
Yeah. So although they categorize it as covered call, I
Yeah.
don't want you to think that it's a covered call. I want you
Okay.
to just read this and assume, would you, without this information, would you still be able to figure out that this is a covered call?
A client needs cash. Within their portfolio is a stock that they are considering selling in the near future and on which their advisor has a bearish outlook over the next 6 months. Information is provided on the 44-day exchange listed options, call input premium, delta plus Vega. Yeah, I mean, I think because I looked at the title, it's making much more sense. But essentially, he will sell a call to net some premium because his view is bearish on the stock. So he doesn't believe that that call option will have any value. So he gets some premium upfront.
Right. But what are the risks?
The risk,
What's the risk in doing so?
he's capped his profit if the share price increases.
Right. So that's the risk that he assumed that he has a bearish view over the next 6 months, but it's just a view, right?
Yeah.
In terms of strategy, yes, that's a good strategy that if I need cash, I can immediately sell a call for a
Yeah.
near future, right? Instead of selling the whole stock, they're
Yeah.
saying, right, they are considering selling in the near future. So this is kind of one of the motivations of a covered call. That if you think that you are going to sell in the near future,
Yeah.
then why don't you sell a call? You can get the money immediately. The
Yeah.
time value has money,
Yeah.
right? But the risk is that if the price goes up substantially, then you will have that regret that okay, I could have just hold it. Again, don't look at this, but then you should know that this is a protective put.
Okay.
How about
Was
this?
budget, but considers them too expensive. Okay, to be no more. Which one? Sorry.
That's the second one scenario. Investor OQ.
Yeah. OQ wants to purchase shares but consider them too expensive at 169. OQ is prepared to pay no more than 165.
Hmm.
Mm, sorry, how this I didn't understand how this is a protective put.
Okay, just don't think about protective put. It is actually not a protective put. Good.
Okay. Yeah.
Good that you figured it out. Hmm.
Investor Q OQ wants to purchase shares. Okay, when considered too expensive at 169. Okay, is prepared to pay no more than 165. Mm, wow. Uh, so basically, which strategy will he implement, right? To
Yeah. What do you think you should do?
uh,
Let's talk about what we have. Uh, it is at 169.
okay, it's at 169.
I and he is prepared to pay no more than 165.
Yeah, yeah,
So
yeah.
you can imagine that playing with call makes no sense, right?
Playing with call makes no sense. Yeah,
Why?
is this like a
Because
call?
no, I'm just trying I'm just exploring all the options that I have.
Yeah, so call.
So
Yeah,
I'm saying,
call doesn't make sense.
let's say I don't know anything, right? I am just reading whatever you are reading in the same
Yeah,
way. So I'm saying that it is currently trading at 169,
yeah,
and I'm okay to buy at 165.
yeah,
So one thing is either I can wait,
yeah.
or maybe if I just buy a put at 165? How does it help?
If you buy a put at 165, you have the right to sell it at 160. Option to sell it at 165.
No, when you say, but no. I'm saying when you buy a put at 165,
Huh. So it's like out of the money currently.
currently out of the money, yes. Yes. But then, how does my payoff would look like? If I buy a, let's just try to consider this.
Yeah. So it'll go. So on the left side, it'll be like a negative slope, linear thing,
Mhm.
and then the cut point would be 165.
165, okay. So think about this. You are buying a put, let's say you are paying a premium 5 rupees.
Huh. Yeah.
If the price goes down to 165,
Yeah.
just think about this, okay? I mean, again, the reason why I'm putting so much time on this question is because I wanted to think from a real investor's angle.
Hmm.
If the price is 169 and you don't want to pay more than 165 and you are buying a put, right? If the price goes below 165, right?
Yeah.
Why will you buy the stock at 165 then?
Yeah. Yeah.
If the price goes to 150,
Yeah.
just go to the market straight away and buy it at 150.
Huh.
Right? You're paying 5 rupees now.
Correct.
Makes no sense, right?
Makes no sense. Yeah.
So sometimes we need to step back and think, are we really doing justice to my strategy?
Hmm.
I'm putting 5 rupees and it's useless because if the price goes down, I can anyways buy at a lower cost.
Hmm.
But think about that. What if I sell a put
Okay.
at 165? Let's just analyze this part.
Hmm.
And are we on the same page that playing around with call make no sense, right?
Yeah.
Or maybe if you want to play around, we can discuss that. No issues in that. Okay.
No.
But let's just try to understand. Agar hum we'll just sell a put, what would happen? So if I'm gonna sell a put at 165,
Huh.
then I'll get upfront 5 rupees.
Yes.
Okay. So at least I've earned 5. Now, if the price goes at 150, now what happened?
You'll have to pay 165 to buy the stock.
Yeah. So I'll have a obligation to
Yeah.
sell the stock.
No, to buy it,
At,
right?
no, I sold the put to
Yeah.
somebody who is long a call has a right to buy. Okay. So and somebody who is long a put has a right to sell.
Yeah. So you're obligated to buy it at
Yes.
150.
So I am obligated to buy at 165.
Yeah.
So that's the risk. It comes under the risk. So if the
Yeah.
price goes way below 165, similar to the above strategy where if the price goes up and we sell a call, then we lose out on the profits.
Hmm.
So even in this case, the risk is that if the price goes down a lot, then I'll end up selling at 165
Yeah.
and then I have to buy at 150. But think about this. Think about this. What if I got 5 rupees immediately?
Yeah.
The moment it reaches 165, you know that somebody is going to execute for sure.
Yes.
Why don't you buy at 165 then
Hmm.
and give it to him?
No. How? But in sell a
Go to the
put,
market.
No,
from the market.
but you are already getting it delivered. That share is getting delivered to you through the put, right? Because the guy he
Yeah.
he will execute the put, and you will
Yeah,
have to buy it for 165.
correct. So I'll buy it from him at 165 and I'll sell it in
Hmm.
the market at 165 at the same moment.
Correct. Yeah, yeah,
But the point is, what if by the time I buy from him and then sell in the market,
ah,
it becomes 160,
yeah,
then that would be my 5 rupees loss.
yeah.
Right? But assuming
Hmm.
that he will execute for sure, then I can straight away buy from him and sell it in the market at 165. I can still earn 5 rupees.
Yeah,
Basically, all I'm trying to say is that's the best that I could do.
yeah,
Because we explored that call makes no sense. It doesn't play a role over here.
yeah,
If I buy a call, sorry, if I buy a put, again, doesn't work for me. But if
yeah.
I sell a put, I can still earn something if the price movement is not so much.
Right.
Agreed?
Agreed. That's
So
why
you
it's a
can
good
write
writing.
exactly. So you can write the OTM puts, which we
Yeah,
agreed, and effectively gets paid. Right? And
got
as
it.
we discussed, if the stock is less than 165 at expiry, we just
Ah,
discussed that, right? Then I can earn money. But the only risk is something that we just discussed.
yes.
If the shares may fall below this much by expiry,
Yeah,
right? In that case, you will have to buy from him at 165,
yeah,
and you will be only be able to sell at a market price, which would be your loss. But that's a risk, obviously.
yeah,
Okay, all right. You understanding everything, right?
yeah. Clear. Yeah.
Let's look at this one.
KH believes the stock price is about to rise or fall dramatically, at least plus to 10%, and considers a straddle. Okay. Before KH makes the trade, news story breaks that increases volatility, making the same straddle more expensive.
Okay. What do you think about that?
So basically, initially he was going to say at a particular strike price, buy a call and put of the
Mhm.
same strike price. But because volatility has increased in the market, the price of the put and the call have increased.
Correct. So does it make
And,
sense?
uh, yeah, he would have to believe that the price movement will now have to be in a wider range than what he did before.
Totally. This is a very good answer. Because yes, so let's say if the when they say the volatility now increases, let's say it increased by another 5%.
Yeah.
So you can imagine that 10% is this one, and then another 5%. So ultimately, the stock price should move by at least 50% for him to break even.
Hmm. 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 Hmm.
Otherwise, this
Hmm.
looks very expensive.
Hmm. Hmm.
And even we
Hmm.
can imagine that 15% movement is not easy to happen.
Yeah. Correct.
Right?
Correct.
So I would rather not buy a straddle at all
Yeah.
because I think that the volatility is too much now, and
Yeah.
the stock price movement might not be that much accordingly.
Yeah.
It says right, the straddle is no longer worthwhile.
Hmm. 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 Hmm.
Just says 12%, but it probably just assume that 2% is the additional
Yeah.
increased volatility. So which is fine. Okay, it's time, but let's just do one more.
Yeah. A client has a long position in a low cost basis stock, which means that selling is ruled out. Need to protect against a decline in price. Hmm. Uh,
So
so,
the moment you read this word,
yeah.
you should think of something that I am going to long and short because it's a low cost basis stock. Okay,
Okay.
just disregard what I just said. I just thought that they are saying that they want to spend less. Okay, low cost basis.
Hmm.
Do you understand what a low cost basis means?
Yeah. Basically, he bought it for very cheap.
Yeah, very cheap. Okay, understood.
Yeah.
Yeah. So they say that
Um.
client has a long position on low cost basis stock, which means that selling is ruled out. Okay, I don't want to sell it,
Yeah.
but need
Because
to
he
protect against the decline in the price. Okay. Hmm.
got it. So then, if you have to do that, then you have to buy a put. Like you're being
Okay.
protective about your downside. And So you just buy a put, and that will protect you against the decline in price. You pay an upfront premium, but now if you sort of suppose you want to offset that, then selling is against. So yeah, short call won't work because he doesn't
No,
want to sell.
no. So basically they say that he doesn't want to sell the stock.
Ha, ha.
So maybe you can just sell a call at a higher price.
Yeah, got it,
Right? Just
got it.
maybe if they think that the price movement from 100 to 110, maybe just sell a
Yeah,
call at 115 or 120.
yeah, yeah,
Right? And then you can use that money to buy a lower price. So,
yeah,
sorry, you can use that price to buy a put
yeah,
that will hedge your downside. Okay. All right. There are two, three more strategies, and
yeah,
then we'll start off with swaps.
yeah.
All right.
Perfect.
I think let's just reconnect again on Tuesday, maybe.
Yes, perfect.
Right, and then we'll plan it out. So basically, I have something to do on this weekend, but then
Ah,
we'll make use of weekends from next weekend onwards. Okay.
okay.
And then just in case you are not available, then we can work it out
Yeah.
that way. All right. So let's just catch up again on Tuesday, and then we'll take
Okay.
it from there.
Sorry about today. Thanks so
Arey, no
much.
worries. No worries at all. I totally get it.
Thank you.
Okay. Chalo,
Yeah.
I'll see you on Tuesday then.
Okay. Thanks so much. Take care.